for stocks.
According to Investopedia, a short squeeze occurs when a stock or other asset jumps sharply higher, forcing traders who had bet that its price would fall to buy it in order to forestall even greater losses.
So if you didn't hear that, short squeeze occurs when a stock or another asset jumps sharply higher, forcing traders who had bet its price would fall to buy it in order to forestall even greater losses. Their scramble to buy only adds the upward pressure of the stock price. Okay. Here we go. Let's try this.
A short squeeze refers to a jump in a stock's price, forcing a large number of short sellers to close their position, which in effect pushes the price even higher. When an investor shorts a stock, he borrows shares from another account and sells them, agreeing to replace the stock at a later date. Short sellers predict the price will go down, enabling them to buy the shares at a lower price. When the share price starts to rise, many of these same investors will decide to buy the stock before their losses escalate further. This flood of buy orders causes the price to climb even higher. First Class Aeronautics, an upstart aircraft maker, recently unveiled its new flagship model. The rollout was delayed for several months, leading many investors to question whether the plane had design issues. Consequently, many of them decided to short the company's stock. But as it turned out, initial orders ended up being stronger than expected during the plane's first few weeks on the market, pushing the company's share price from $17 per share to $20. Fearing a continued surge, many of the short sellers bought the stock to close out their position. These purchases pushed the stock higher still to $23 a share. It's important to remember that this secondary push has more to do with the large number of short positions than the stock's fundamentals. Contrarian investors will sometimes try to cash in on this phenomenon by taking a long position on heavily shorted stocks, that is, buying them with the hope that they'll appreciate. Going against the crowd like this is typically a high-risk, high-reward proposition. Even so, some feel it is safer to bet on a stock rising than on one falling, where the potential losses are limitless.
All right, well, that was interesting. So now that I kind of explained in it, so what is it good for us? It doesn't make sense to me, but let's try one more thing here. Let's try this video. Sorry for the commercial. Oh boy. Let me see here. Nope, we don't want that. Sorry about that, guys. All right, well, that's basically it. How to find, here we go. How's everyone doing today? All right, last one. Let's see here. Sorry, we have to deal with these ads, but we'll get to it eventually.
I had several questions regarding changes to my stock investments. TurboTax experts assisted me in entering the correct information, which was quite a relief.
Short selling is a concept that can be confusing to a lot of investors. So if you feel a little uncertain as we go through this description, hang tight because we're going to do a case example to make it much more clear. Short selling is basically opening a position by selling it first, assuming that in the future you're going to be able to buy it back for a cheaper price. Now, how do you do that? Well, when we sell to open and buy to close, you're basically borrowing the stock from somebody else. And in reality, you're borrowing it from your broker, basically. So you sell to open by borrowing the stock, and you don't need to worry about that. It's just an order type. Sell to open is the order type for selling short on a particular stock or ETF. Now, buying to close is just unwinding that position, or basically buying the stock or the ETF back later, and hopefully at a cheaper price, so you get to keep the difference and then pay that back to your broker. Now, margin and interest is going to be required and incurred in a short trade. And what I mean by that is that you have to have a margin account in order to engage in short selling. If you don't know what that is, spend some time talking to your broker, find out whether or not you're qualified to use margin and whether it's something that you're interested in. And assuming that you are qualified for margin, short selling does incur some interest charges because remember, you're borrowing stock from your broker, so they're going to charge you for that.
Okay, did anyone get that? All I know is, yeah. Okay. So, let's see here. If we are still going, there we go. Let's see if we've been recording. I don't know if we've even been recording, to be honest.